Well, I think probably the key takeaway is that whereas we moved up the risk curve quite considerably in 2014, apparently people want to go a little bit further. I think that's the first takeaway. Secondly, is that people are looking for yield wherever they can find it and are willing to leverage up now that debt seems to be coming back into the market. It plays out different regionally. I think probably the lack of debt in Western Europe and difficult debt, well, it's not difficult in the UK, but it's still a bit constrained in the UK, stands in contrast to, say, the US, where debt has come back in a big way. So you have the US investors coming in looking for fairly high leveraged IRRs. Well, the real estate sector, of course, we're talking about the occupier markets and firming of demand that would come on the back of expansionary sort of economics. I keep waiting for the Eurozone or for the EU in general to start registering a little bit stronger growth, and it continues to disappoint. How disappointing has it been? Well, when the biggest news and the biggest sigh of relief is that Germany didn't go into recession in the last week or so, it tells you exactly sort of where the EU is at the moment. Going forward, I think things aren't as bleak as they look. One of the links that Europe has that drives a lot of, say, export growth from Germany, and a lot depends on that, is the Chinese economy. And they've just announced in the last couple of weeks that they're going to have a much more liberal monetary policy to try to stimulate growth in China. And I think that forebodes well generally for Europe. Will it catch up to the recovery levels that we've got in the UK? Eventually. I think that the UK has probably moved ahead much more rapidly. I think the investment flows have come back, i.e. the business investment flows, not necessarily the property market. And that should mean that within the next 12 to 18 months that Europe should be on a fairly good trajectory too. We can hope.